Well, good afternoon, everyone. So we have here a quite interesting panel, and indeed it's quite also maybe a sign of the day that this panel is taking place the first day and in the early afternoon and not at the very end of any sessions. So just we will go quickly through this big theme we have to cover, distress and stress, but maybe just a quick introduction. I would like to highlight you have Prequeen here as in the exhibition hall, but you know that they provide us with many data, and globally what we can see from their latest fundraising statistics is that globally what we refer to distress and to special ops funds are globally representing nearly 30% of the private debt space as a whole, so it's a major concern. This being said, what I found interesting as second data is that since 2017, the number of funds and the fundraising the amount related to this distress and special ops have been declining as opposed to the other space of private debt. So maybe that's a sign that there was a lot of funds raised in these strategies, and that will be the actually the debate today to see if and when there is some real opportunities. And just to start this, because we usually have this raising concern about negative feeling. This being said, I will just wanting to introduce saying that we have today a current market environment which is quite very still positive, very attractive. We do see the stock market which is in record territory, unemployment statistics in the US and in some European countries which are very low. We do see that the threat of rising interest rates are fading away, and so many globally in our portfolio, globally, if you share the views, the Q119 data quarterly reports were quite above expectations, so a lot of very positive trend. And this being said, you hear more and more this concern, especially among investors, that it's the end of a credit cycle. And so that's my first question. But before, maybe I will let these eminent people introduce themselves and see what they are here for. And the first question will be obviously to know if and when and there is a credit cycle and how you define this credit cycle. And it will be too easy if the fire alarm will indeed ring and say, here we are. I think it's a bit more difficult to indeed assess, and that's why we need to have this kind of talented asset manager to provide you with some of their internal views on this. So I will let maybe Michael start.
It's quite a build-up. Thank you.
And so you please introduce yourself quickly.
Eminent. James knows the truth. Changes. I'm Michael Guy. I run Crestline's business in Europe. Crestline is an alternative manager. We were founded in Fort Worth, and that's still where the center of gravity of the firm is. It's 125 some odd folks, and we invest money across a range of strategies, from what we call opportunistic, which is imaginative, through a mid-market direct lending strategy, through to CLOs. We also have an equity long-short business.
I'm Bruce Richards. I'm the CEO and chairman of Marathon Asset Management. We're headquartered in New York. We have offices here in London and in Singapore. 165 professionals managing $16.5 billion in capital, primarily focused on global credit.
I'm Reji Vettasseri. I work for Morgan Stanley Alternative Investment Partners, which is a $10 billion private market solutions group that invests in primaries, co-investments, secondaries, and has a large credit program focusing in particular on more opportunistic credit strategies.
Okay, thank you. So there is this general consensus that there is the end of a credit cycle. Do you think, Reji, that is correct? And what would be your KPI to say so?
Well, it's always the sort of tough question to call exactly when the end of the credit cycle is, and there are far smarter people who get this wrong on a regular basis, so I won't make that judgment of when exactly things will turn. But what is relatively obvious is that we are in a good period now. Default rates in credit are around 2%, they peak typically at 10%. And that period is not just about to end. We will, in any investment period, in any fund we invest with, have to deal with a period of time when things will actually be very rosy. It's also highly likely, as many people have pointed out, that that cycle will turn at some point, and probably over the next 5 years of any investment period. So it is likely that any manager that we invest with right now will have to live in the best of times, the worst of times. And as we sort of look at managers, now more than ever, we need to build all-weather portfolios full of all-weather managers who can deal with both the sort of the challenges of deploying in the sort of current market environment in a disciplined way, as well as taking advantage of opportunities when and if the cycle does turn, not knowing exactly whether we're going to have half good, half bad, or mostly good, a little bit bad.
Maybe Bruce, if you want to comment.
I'll comment on the question and then also maybe add to a couple of points Reji mentioned as well. So, the big question is, when does the credit cycle really turn? And no one has that answer, but what's, I think, most definite, it turns when there's recession. It turns definitionally when the high yield spread, the Maryland's Master Index or whatever index you want to look at, touches 1,000 or wider. Because that 1,000 spot is exactly the point that definitionally defines distressed. So if you can, different ways of defining distress, but if you want to take the one most important definition is when the high yield market's at 1,000. And so that's not going to happen in our estimation until you get to a recession, until fundamentals really deteriorate, corporate earnings deteriorate, and then you'll get to see exactly how much paper is out there which is going to be restructured and which is problematic. And we believe that the next distress cycle, default rates won't get to 10% like it has every prior default cycle. So if you look back over the last several decades, since modern finance, and really since Michael Milken invented high yield and leveraged loans, started trading institutionally, which is in the 80s, you've had three big recessions, 1991, 2001, which is more US, 2008, 2009, but the 1991, 1992, and 2008, 2009, they were global recessions. In 2012, of course, here, more regionally, like 2001 in the States. And in each one of those cases, the Maryland's Master High Yield Index traded at 1,000 over. And default rates went to 10% in each one of the prior recessions. But we believe since the world is basically covenant light, companies will be able to kick the can down the road considerably further and longer than they have in the past. And so 7 will be the new 10. That is, default rates won't get to 10. We believe they'll only get to 7. You want to wait for a distress cycle. You don't want to time a lot of things in life, like investing in equities maybe, or re-upping for that next private equity fund, or investing in real estate and holding your line. But in distressed debt, if you built a portfolio of distressed debt today, I think it's kind of an oxymoron because there's not a lot of distressed debt besides the crap that you put in your portfolio that's, besides the few names that you want to own. So there's not a lot of distressed debt today. And so you'll see a lot of if you ran a distressed portfolio today, I think you'd make like 8 to 10% the really hard way, taking pretty poor risk reward to make that type of return. When you're coming out of a distress cycle, like coming out of 01, 02, coming out of 08 or 09, you're going to make 20% plus returns. I know we've made 30% plus returns in those environments coming out of those recessions. And so you really want to wait for that period of time. You only get an opportunity in distressed, real opportunity for distress, unless you want to look at an industry like energy, but you only really get a broad opportunity in distress every 6, 8, or 10 years. You got one in 2001, Before that, 1991. You had to wait till 2008, and here we are in 2019, and there's no distress cycle in sight. Not this year, and probably not, in the next 12 to 16 months. The second half of 2020, we think things might start to be a little different, but there are specific signs we look at. But don't pay dividends in advance. Don't focus on investing in distress today when there's very little distress worthwhile investing in. And everyone will come through your doors, knocking on the table, asking for capital for their distress fund. They did it 4 years ago, 3 years ago, 2 years ago, and they're tying up capital without being able to really deploy that capital today in the marketplace. And one final word, and on kind of the whole middle market space, I think Reji's right. When you look back 5 years from now, back to today, you'll say, hey, most of those middle market funds were really bad vintages because you go through a distress cycle, and these smaller companies are big problems when they go sideways, despite what anyone will tell you. Really hard to launch in there and turn around these smaller companies. And in the US, here's a statistic, the middle market space, middle market sector, upper, lower, the whole range, prior to 2008, going into that calendar year, was 175 billion. Today, it's 925 billion. It's been a 4 to 5-fold increase of middle market lending since then, as the shadow banking system has evolved in a very big way. And that evolution is not just from funds, but BDCs and other vehicles that fund those companies.
And Michael,
That's terrible. So I'm in this awful place now where I'm going to disagree with Bruce, which was never part of the plan. So distressed guys always grumble. And I was also going to say that you can't make a career kind of waiting for the correction, right? And Bruce clearly has. So the living proof is right next to me. Damn, where to go from here? So when I was in college, if you couldn't answer the question, the trick was always to change the question. So when's the cycle going to change? Isn't a great question, I don't think. I think the question is, why do you care? And clearly you do. So what question are you really asking? So when I thought about this, I thought, what question are you really asking? Are you asking, when's it going to get easy to invest? Right? Because, is that what people are asking? Because if that's the case, then, we would all say, well, gee, in 2008 it was really easy because, first lien senior secured bank debt in good companies was at 80 cents on the dollar, and my grandmother could have made money. But the reality is most of us honestly were hiding under our desks, so that didn't really work. Then I kind of go back and just kind of roll it back a bit further, kind of think about when did things last get tough, and then maybe 99, there's a bit of a sort of sustained kind of wobble in the markets, and then I take it back a bit further. There's been like a handful of corrections when you could reasonably expect it to have done really well. And as Bruce says, like 3 or 4 occasions in our careers, right? So it's tough. So let's not wait until it gets easy, right? Because I don't think it ever really does get easy. So the question is, what am I really asking? Should I change my behavior as an investor because I think we're late in the credit cycle? These Americans always say like 7th innings or 9th innings or 11th innings or whatever the expression is you all use. And we're in this kind of late innings, and I don't think you should change your behavior, right? Because if you've committed to good managers who have good strategies, and for the context of this audience, if we're looking at private lending where, we've made prudent decisions about giving money to smart managers like core debt who are top of the capital structure, 3 times levered, 300 basis points per unit of leverage. That's great, right? And then the market falls on its face, the probability of losing a significant amount of your money is probably very low, right? So that's pretty good. You can't time that. So the question I think you're really asking is, how can I find some inefficiency? Not how can I, not is this the right time to change what I'm doing? And then the real question you ask is, where's the inefficiency? Not like, where are we in the market? That's kind of, I think, the question is. And from a European, I think I've spoken far too long, stop me if I have. But I think the one thing I'm going to say is, Bruce says, mid-market lending has gone from a small number to a really big number. Well, the European banks provide more capital. This is going to be a humbling statistic for us all in the room, right? The European banks provide more capital to European companies every 10 weeks than the US high yield market, full stop, right? I mean, it's like a huge number, right? And institutionally, none of us are really addressing that. You know, there's a handful of people trying to dig into smaller, non-sponsored, multi-trillion-dollar asset class that is like on its knees because its model's broken. So it's all about inefficiency and not about timing. Yeah, I'm not too worried about timing. Does that make sense?
Well, basically they didn't really answer the question. But anyway,
No, it doesn't matter.
That's
Spent a long
fine.
time doing it. So
no,
it's
but
okay.
I'm happy to be on this side because usually I will say that there is no real cycle
The cycle will
impacting.
end when there's a recession, and that cycle will not end anytime in 12 months. And beyond that, you have no visibility from this point in time to make that prediction. So wait till you see the whites in their eyes. Wait till you see that opportunity, because you'll be getting paid handsomely, really handsomely then, and now you won't.
No,
But then we got disasters going on, right? So if you were a European equity investor, if you were the Eurostoxx banking index at the trough in 2009, because it's not really the trough, right? Here's the key: you actually lost money, right? So like European banks, it's an abject policy failure on the part of we Europeans, right? So we got what was been the biggest bank that I've observed, the biggest, most successful institution in my career, Deutsche Bank, trading at 0.2 times price to book. Last year, European banks sold 207 billion euros of NPLs. If you want to invest in distressed, how about anything in retail? I mean, so I think my point is, distressed guys always say, bad times are around the corner, we just have to wait, and it's all going to be great, and this year's going to suck, but it's going to be great, just be patient. I think the point is, don't take this the wrong way. I mean, distressed guys are like cockroaches, right? Like they survived, and I was one of them, right? So we survived the nuclear blast, we're always here, right? So there's always something to do. So I don't think that, I don't think it's, go on.
There is always something to
There's always
do.
something
I
to
mean,
do.
we've bought billions and billions here in Europe, our European team, of NPLs out of European banks. But we're harvesting a lot of that. In fact, just a couple of weeks ago, a few years back, we bought out of NAMA, a big property site right at the Houston station in Dublin, big office complex, and bought it for about 120 million euro, and just sold it 2 weeks ago for 240 million euro, and took out all that cash flow and made a lot more than 2x because we financed it. And we just put on the market just this past week, it was in the Irish Times, our apartment portfolio in Dublin, about 1,000 apartment units. And so we're harvesting a lot right now. And we're still buying. We're buying NPLs in Italy and Spain and a little bit in Portugal. So we still are buying. But I'm saying that the question's really about the big distress cycle. And when is it coming? And should you time it? And I'm saying we don't know when it's coming, not in the next year. And you absolutely should time it, because you get to bite that apple every once in a while. And it's a big, juicy apple. And so you can find some crappy retailers to invest in and make a low IRR and take a lot of risk.
It's probably fair.
Or you can wait.
But we're still
Well, I think it's
That's
important to
maybe a
realise that
question
there's-
for Reji in terms of to dive into private debt structure. Either any evolution in terms of fund structure that you've seen which are precisely trying to address this time issue?
Well, I think there's a couple of things that people are doing. So perhaps the most important, although it's not necessarily a question of structure, is that people are asking for more flexibility. There are more and more distressed managers who are rebranding themselves as stressed managers or complex situations more generally, asking for the flexibility in this point in the cycle, because it's difficult to find the kind of distress which Bruce is referring to use their skill set to invest in other sorts of situations, whether that's, real estate, development loans, or other things which you see some of these managers doing a little bit more of now. And that flexibility can be useful, although it's important that that flexibility is still constrained by the skill sets and the abilities of those managers to deal with it. And that allows you to deal with that cycle a little bit, not least because different parts of the distressed market are most powerful at different times. The hard distressed is most powerful and most attractive right at the bottom of a cycle. NPLs actually become most attractive, I think, in the early stages of recovery, when the banks actually have the incentive to go and offload these things. Some kinds of direct lending to quality companies at distress levels often work when you're in the middle of a crash. Uncertainty is greatest, which means that those people can't get loans at the levels that they most like. So that flexibility we see a bit of. We see a few other things like trigger funds occasionally coming into the market where people have asked for actually the amount of capital they have available to deploy to change depending on exactly where we are in the cycle, which is a sort of interesting development.
And I think Reji touched on it. I mean, trigger funds, and when we bring our distress fund, that's what we're bringing. You get to a certain spread or default rate, then the capital becomes active then. And so I think that's the way for distressed. And the number one thing we're doing in the kind of the private markets today is asset-based lending. Aircraft leasing, lending against plant, equipment, inventory, receivables. Our healthcare team lending against healthcare assets, including earning the royalty streams, and things that are senior secure, asset-based, cash flowing, where we're in at 30, 40, 50% LTV to the borrowing base, and we have a perfected interest in that asset that's locked down, and our lawyers are structuring that, and we're lending to these middle market companies. Our unitranche team lending, but is asset-based as opposed to cash flow lending like your traditional, and there we're making, nice double-digit returns to these middle market companies, but senior secured, and the important thing is it's asset-based, whether it's the property, the plant, equipment, IP rights, that we have as our perfected interest in that security package.
And I think that's absolutely right. I mean, and the point is, to Reji's point, I sort of disagree with you as well, Reji. So, apologies. I mean, I don't think there are necessarily perfect times to do certain things, right? So I think there's one great time to do anything, and it's when no one else wants to do it, right? So it's all about inefficiency. And so I agree with Bruce, right? So we do a lot of asset-based type lending, aviation and royalty streams and PP&E in Europe at Crestline. And we do that because the banks are inefficient and the banks don't want to do certain things and there's a dearth of capital, and we can extract supernormal returns for doing something that just where the probability of loss of capital is really low. That's just inefficiency. It's not about market timing. I just want to come back on something you said about recessions. I mean, the reality is, Germany's growing at third quarter is less than 1%. Pretty much all of developed Europe is bouncing along the bottom. I mean, it could get worse, clearly, right? But it's pretty bad, and there's no sign. There's no sign of that playing to our strengths, right? So the US looks great, right? I mean, we love Donald Trump or hate him, right? Because the 3.2% GDP growth looks pretty good if you're a European. So yeah, I know we could all kind of get very old waiting. Right?
Yes. So the paradox for the LPs and investors in this room, I mean, my view is it's a little late cycle, although you don't want to time this one, but a little late cycle to do middle market direct lending because of what Reji said, and it's going to be difficult when you have a recession these next several years. At some point during your investment cycle of that 7-year fund that's making that 5-year loan. And so it's a little late for that. And, lending it, I'm with Michael over here, lending it, and the fellow who was up here from Sweden prior, lending it 3 times is fine. But here's the truth. The truth is that the institutional loans that are out there, 67% of it, 2/3 of it, has a debt-to-EBITDA ratio in excess of 6. And that doesn't include the actual EBITDA, right? Because they got the add-backs and adjustments and all the nonsense that's played. And so add a turn to that as your average, okay? And that's your average institutional loan. Middle market loans are just as bad. Why? Because the equity multiple is really high. The equity multiple is 16, 17 for, kind of the large markets, and the middle markets are getting done, although they'll say it's a lower number, at 8, 10, and 12. And so when you're lending as 40% of, equity check, and 60% of that's being financed, your debt-to-EBITDA ratio is going to be 60% of that number. It's going to be a 6, 7, 8 number. That's most of your middle market lending. And if you don't believe it, then you're actually not looking at the transactions and actually getting the actual trailing 12 months. but wanting to build in these pro formas and these add backs and these adjustments to kind of justify a lower number. So when you have large multiples and weakening covenants, and the covenants may be more in place, but they're getting weaker and weaker and weaker for even the middle markets, you're going to have some issues when the markets go sideways, when there's a recession. And so
just maybe to continue on this, because there are...
So just real quick. So I think it's late cycle from middle market lending. I think it's a little early cycle for distressed investing. And so right now, if you can do the things that Michael's talking about, asset-based lending, senior secure, asset-based, it's perfect. If you can set yourself up, as Reji said, for the distressed fund that's coming with triggers in place so they're not going to do silly things with your money and actually invest when the opportunity is there, then that's a perfect thing to do on that side. And in the middle market lending, just make sure you invest with the best managers that are really lending at these low multiples and are the best of breed, because there's 100 managers that have come to market that have never been in the market before in middle market programs. They've saturated this market. And so you got to be very careful, because their lending terms means on every deal which is competitive, there's 5, 6 term sheets being offered that company. And so even if you're an incumbent manager with really good discipline, you're going to miss that deal unless you match those terms. And that's just the reality. The world's picked over. Your Ribor's negative rates, low rates kind of fixed across 2.5% yield curve in the U.S., and all the central banks, the main central banks in the world, have continued liquidity they've put in the system. So it's a very tough time as a credit investor to invest, which is why you need to be super duper careful right now and really disciplined with A, manager selection, but B, also the strategy.
Yeah, but I guess that, what we are here for, and everybody is very disciplined, but then because there have been these huge funds raised for related to this strategy, do you think that the abundance of liquidity will impact now the performance of these expected distressed special ops funds? How do you see this paradox in between having this huge...
I don't know. Can I just break some glass again? So I sort of agree with Bruce, which is that there's a lot of liquidity that creates competition, and we've kind of gone down the route of some bake-offs in kind of mid-market lending just for the for grins to find out what the process was like, and you improve a covenant and you improve the quantum of leverage and you still lose. So that's been quite instructive. So we kind of put that to one side. I think the interesting thing is, we all, as kind of relatively sophisticated investors, we kind of lose track of the fact that we're a bit of a sideshow in Europe, right? So in the U.S., institutions and non-bank institutions are very relevant. Here, the vast majority of capital provided to corporates is provided by banks, right? And I think, we provide capital solutions to companies. We never compete with someone like us, right? The competitive environment for what we do is really benign. The challenge is actually finding the deals, and institutionalizing what we do. So, there's a
I
10...
guess, yes, we are
yeah.
about
James,
to be...
sorry.